cautious Fed kept rates on hold this week, but for how much longer? This is Macro Matters, and we're talking the outlook for US interest rates. The Federal Reserve is clearly in no rush to cut them. This week, policymakers slowed their predictions of how soon rates might come down and raised where they see the eventual stopping point in the so-called dot plot. Odetta Kushi is Deputy Chief Economist at First American. Odetta, the economic data continues to look healthy, but policymakers do seem nervous, don't they?
They sure are. They're walking a bit of a policy tightrope. All of the labor market data continues to demonstrate resiliency, though higher frequency data like jobless claims is trending higher and pointing to a weaker labor market. The overall inflation picture continues to improve, but of course there are concerns about a pass-through on inflation from recent tariffs.
As you say, they're trying to insure against higher inflation coming in the second half of the year. But how long do you think it will be until we can assess the size of that impact?
We need to wait until at least the summer to start to see some of the impacts on inflation. And even market participants are thinking that even if we get a rate cut, that first one won't come until September.
How much do you think policymakers should be worrying about the other side of their mandate, the labour market?
I absolutely think that they need to think about it, that they need to make sure they don't fall behind the curve. Labor market is strong right now. The unemployment rate is still historically low, but we know that people are staying put at their jobs. Hiring intentions on the part of employers are falling. And so we want to make sure that the labor market doesn't quickly turn. And then, of course, the Fed would be behind the curve.
Is there still space, do you think, for the Fed to pull off a soft landing, or are we going to see clearly a more negative couple of quarters?
I still think that a soft landing is a possibility, but I do think that the Fed's job is certainly going to get more difficult in the second half of the year. Their outlooks are clouded with uncertainty, as Powell himself noted. And it is interesting to see that while the median projection from the Fed is still 50 basis points of cuts, there was an underlying hawkish pivot in that 7 FOMC participants actually expect no rate cuts this year, which is up from 4 in March.
Do you think then that markets should adjust their own expectations?
I think we'll see with data coming in on both the inflation side and the labor market side, but certainly there is a possibility that we'll see higher rates for longer this year.
What's the impact then of sticking with such a high rate of borrowing on the wider US economy?
Well, we know for the housing market that interest rates aren't directly tied to the federal funds rate. They're tied to that 10-year treasury. But I do think it means that interest rates on mortgages are going to remain high for some time.
And are you seeing an impact then on people's ability to buy?
Certainly. The affordability is still very strained in the US housing market. We're seeing that in existing home sales, which are really struggling to break above 4 million annualized sales. So we have a lot of potential buyers sitting on the sidelines that can't quite make that affordability equation work for them. And then we have existing homeowners that are still rate locked into their homes because they locked in those 3% mortgages over the pandemic and they just don't have a financial incentive to sell. But on the bright side, there is more inventory hitting the market, and so there are more choices for people to choose from.
That was Odetta Kushi of First American. Don't forget, you can watch more videos on Reuters.com.